welcome, and thanks for waking up early to listen to tax. I did a presentation last night to real estate investors, so it was also late. I don't know why it doesn't allow me to move, but that's okay. I had been a realtor years and years ago because I got bored at working at Loblaw. I was working at Loblaw as the senior manager of external financial reporting. Before, if you learn about the earning per share, hear about earning per shares on radio about Loblaw, those calculations done by me at the time. But I got really bored doing those work. And so when I met my husband, he is a real estate agent. And so then I was thinking, oh, maybe I should join him. So I did it for a couple of years and I got pregnant. And as some of you mentioned, it's easier to, as some of you know, it's not so easy to control your time, especially during nighttime. When I have to take care of the kids. So, and at the time when I was looking for ways to lower our taxes, there aren't an authority out there to explain. So then I decided to learn it and share it. And that's how I started my own accounting business. I went to Waterloo and I graduated from Waterloo Accounting in 2006 and I wrote my exam same year. And that's pretty much my history. Being a real estate agent as well as my real estate, I guess my accounting career. I don't know why it is a bit fussy, but I wrote 2 books. And for those of you who, one book is for real estate agents that was published 2 years ago. And the first one was actually for real estate investing. And I wrote that a long time ago just because I started investing in real estate in starting from 2011. And there's no books out there explaining in simple terms. So I don't know if you guys want a copy of the books. Who has the books, hasn't had the books yet. I also am on all social media. I'm on mostly YouTube. I don't know how to crack the Instagram secret code because I could never get enough followers, but it's much easier to get followers on YouTube apparently. And if you want to follow me on social media, you can search YouTube and then search Cherry Chan. It's one of the most searched terms on YouTube to find my channel. But the channel name is Real Estate Tax Tips. So the same as my website, same on my Instagram, same on Facebook, Real Estate Tax Tips. There's a lot of videos talking about mostly taxes for real estate, as well as for real estate agents, there's a special playlist for them, for you guys as well. A little bit of disclaimer, I try to be as accurate as possible, but the information presented is for general purpose only. If you ever need to have specific question or want to implement certain strategy, make sure that you consult with someone that knows your specific situation. If you are not currently working with an accountant, we're happy to help, but it's really presented for general purpose only. And then I just wanted to start off with the top 10 tax deductions because right now it is tax time. So I'm sure it is on everyone's mind what you can deduct and what you can't deduct. And so I always like to start off with, this thing is over, okay, finally goes away. I always like to start this conversation with the general deductibility rule. The reason being is because there's no accountants out there that would be with you 24/7. So the general deductibility rule essentially is specified in the Income Tax Act that you're allowed to deduct expenses that you incur for the purpose of earning your business income or property income. So as long as you're able to establish the cause and effect relationship between incurring the expense and earning the income, you should keep the receipt. That's what it really means. If you have no receipts, there is no deduction. Now, so if you are taking a mortgage broker out for coffee and you're trying to generate leads, then you should write down the person's name on the receipt, as well as keep the receipt and keep a clean record of that receipt, because you would be able to establish that cause and effect relationship. Now, if you're in doubt, accumulate a bunch of those receipts that you're in doubt at the end of the year. Have the conversation with your accountant, see if they are deductible. But if no accountants out there would be with you 24/7, but without keeping the receipts, you get no deduction. Now, another thing that I want to mention is that you need to keep your credit card statement, you need to keep your bank statement. But having just the credit card statement and bank statements, they're not good enough in CRA's eyes. You actually need to keep the original receipt. Even if it is Home Depot, buying the nails and putting your signs up, those receipts fade away. You still need to keep the original receipt. Nowadays, you would be able to take a picture of it. A legible copy of your receipt is acceptable by CRA, but you still need to take the action to take a picture of it, right? So you still need to keep everything. You would not be able to substantiate any of your claims by using just the bank statements and credit card statement. CRA doesn't allow that. So if you present this and no receipt, CRA will disallow all your deductions. So your tax receipt also has to be kept for at least 7 years. And it has to be legible, so make sure that you take a picture. Meals and entertainment. So going along with that general deductibility rule, you're allowed to deduct any reasonable expenses that you incur for the purpose of earning the business income, and subject to a list of exceptions specified in the Income Tax Act. One of the exceptions is meals and entertainment. When you do meals and entertainment with your client, you are eligible to deduct them, but only up to 50%, as many of you would know. The amount also has to be reasonable. So if you take your one client out and you spend $10,000 on the bill, the amount is not reasonable. So CRA I would personally still deduct the $10,000, but CRA could deem it as unreasonable, and therefore they would only allow a reasonable amount out of that $10,000 receipt that you provide to be deducted. So the amount has to be reasonable. Now, meals and entertainment also includes all the receipts that you deduct with LCBO, beer store, any entertainment store, any entertainment value. If you take a client to Raptors game, that's only 50% deductible. It's also worthwhile mentioning that if you have meals and entertainment expenses, you need to write down the person's name, that you're the client that you're taking having dinner with. Another thing is that if you buy clients a gift card with LCBO, a gift card with the cake, same thing. It's only 50% deductible, even though the entire gift card is given to the client. There were court cases, actually a realtor taking CRA to court, and they lost. So
is that just restaurant gift cards, or what about the other gift cards?
Restaurants gift card, LCBO gift cards.
Besides that, other gift cards?
Any gift cards that could be linked to meals and entertainment in general.
It's only 50%.
But if you are buying gift card like Home Depot, HomeSense, Walmart, Supermarket is grocery, so they would also fall under meals and entertainment. So you try to avoid those gray area. You want to stay on the side that has nothing to do with food.
Nothing with food?
Yes.
Okay, so that we'll consider a full amount.
Yeah, so Amazon gift card, Home Depot, HomeSense, Baby.
Canadian Tire.
Yeah, Canadian Tire, those would be good.
Isn't it only up to $50 if it's gift card?
No. You can give whatever you want to your client. But I think your $50 or $200 rule is from an employer giving it to an employee. You can only deduct certain amounts without having to add the gift card amount to the employee's salary as taxable benefit.
So if it's for a self-employed, it can be any dollar amount.
Yeah, supposing it has to be reasonable as well, right? Mm-hmm. What is the reasonable? If the clients, you did a deal and earned $10,000 commission, and you're giving the client $20,000 gift card, that's not reasonable, right? It has to be somewhat reasonable to what you are customarily doing.
10,000 or 50%.
10,000, 50%.
It's a lot, 50%. But if it is usually how you handle every other client, then there is a basis for it. But if there is no basis and this is just the only one, then that would be harder.
So for your receipts and things like that, that obviously fade over time, you recommend like scanning them and creating some kind of like a
Yeah.
PDF or something? Or
Yes,
or
yes. So,
That's lots of work.
yeah,
You have
it
to
is.
Scan all the time.
Yeah, absolutely. So usually we use a picture. So if you're using any app, any software, online accounting software, the accounting softwares, for example, QuickBooks Online, I'm not recommending QuickBooks Online, but if you use QuickBooks Online or QuickBooks Self-Employed, they have a function to allow you to take the picture automatically
With your phone?
with your phone. Now, having said that, QuickBooks Online, once you end the subscription, you would not be able to access any of that information. So if you take a picture in a different app or just a photo, some people would have a dedicated just email address and send it to that email address, and it's all there. Like different people have different way of storing their receipts, but taking some sort of a picture would make sense.
But the Home Depot one works really well because you get the receipt emailed to you.
Yeah.
Right? So,
Yeah.
So that's how it's
Because they probably recognize that their paper receipt is shit, because
is.
it is.
After 1 year, it's gone.
Yeah.
The numbers
Yeah.
and the.
If you have it in your
It's so
pocket
weird.
too long, it fades away.
Yeah, absolutely.
And
So
they ask us to keep for 7 years.
yes, well, 7 years is only for your business. If you own any rental properties and it's capitalized item, you're supposed to keep it forever until 7 years after you sell the property.
After you sell the
Oh
property.
my god.
Yeah,
So
if
I
it
have to
is
scan
added.
all the receipts.
Yeah. So automobile expenses. So the many of you know that we can deduct automobile expenses. Just going back to the same general deductibility rule, the most commonly asked questions that I get is, what's the percentage? What's the most aggressive percentage I would be able to deduct? Usually, people ask me, is it 80%, 70%, 90%? What's the average? Everyone's situation is different. I don't know if we got part-timer here. Sometimes I meet part-time realtors. Their percentage of car use for business use is very different from a full-time dedicated realtor who traveled to Barrie, Hamilton, London, and then going back to Peterborough to do deals. So it all goes back to your actual scenario, and you have to keep an auto log for tracking your mileage. So everyone has an auto log, right? I'm sure everyone has an auto log. I don't want an answer. That's a no.
That's the, auto.
Yeah. So then you're eligible to deduct the car lease. I think right now in 2023, the monthly lease, maximum lease you can deduct is $950. You're also allowed to deduct the capital cost allowance, or if you were to purchase your car. And the capital cost allowance is the depreciation, but it's the tax term for depreciation against your car. If you are buying EV and plug-in hybrid with an emission rate lower than certain amount, you would be able to claim a bigger deduction. I think right now it's up to $61,000 or $62,000 in 2023. If you were to buy a Tesla this year, you would be able to deduct up to $62,000. But if you were to buy a vehicle those non-eligible one, you can only deduct up to, I think, $39,000 now, increased to. So the stuff that you would be able to deduct includes gas receipts, maintenance, license registration, insurance, and interest costs, and obviously your depreciation on your vehicle if you purchase it, or if you were to lease it, a portion of your lease. And the actual amount that you would be able to deduct is really based on your auto log. If you are using 90% for business purpose, 90% of your expenses would be deductible up to certain maximum. Parking, on the other hand, has to be 100% deductible. But so if you're taking your clients downtown Toronto to see properties, then all these parking expenses would be deductible. On the other hand, the parking expense that you incur by taking your parents to the airport, then that parking cost is not tax deductible at all. It's not being prorated at all. I personally prorate my 407 bill as well. I put 407 there. Some people like to hand select those trips for 407. It's too much work for me, so I just put it all in there.
That's crazy.
Yeah. So people often ask me questions about buy or lease. I did a YouTube video on buy versus lease. And then there's tons of follow-up questions. Can you do a buy or lease on Tesla? Can you do a buy or lease in vehicle in the corporation or not? So I haven't got to answer those questions because it takes time to do those analysis. But if you want to know more about buy or lease, you can go to my YouTube and watch that video. And as you know, like this is one of the most popular video because everyone wants to save $28,000 on Tesla. So if you want to buy a Tesla, there is that video. It's a quick one. The EV purchase is $61,000 this year. I didn't update it, and $39,000 plus HST. The biggest difference between buying a EV versus buying a regular car, the amount of deduction is different. There is also the difference of no recapture. So when you sell the car, if you claim it under the regular car, even if you sell it for a profit, as you know, the used car market has gone nuts in the last 2 years. If you sell it for a profit, there is no capital gain at all. Like it's not going to be added back to your income. But with the EV deduction, even though you get extra deduction in the first year, there are tricks that we can do from an accounting point of view to help you minimize the amount that you would have to take them back into income. But there could be some income impact when you sell your vehicle. If you are buying, you're claiming the extra deduction. And when you buy an EV, you cannot take any credit from the government because there are some government incentives depending on the type of EV that you're buying. You cannot take that to claim the extra deduction. Okay. Now, the other thing is brokerage fees. This is your system, do your brokerage use Lone Wolf as well?
Yeah, something similar.
Yeah, okay. So essentially, this is a sample that I have from my client. Sometimes the brokerage fees, every brokerage has their own way of doing their T4A. At the end of the year, typically you get a T4A from your brokerage specifying which deals that you have, what you have received, what you have collected. So people would have a commission total, but then that $178,000, it's really hard to see is the total. But sometimes they show that $178,000 on your T4A income as your T4A income, and the deduction is really the brokerage cut. So, but unless you provide this information to your accountant and pointed them out, or unless your accountant actually do a reconciliation for you, they wouldn't know to take off the deduction if they only go with what the T4A says. So I know it's hard to comprehend what I just said, but essentially make sure that you reconcile, give this tax worksheet to your accountant and make sure that you maximize your deduction. Some people would just report $178,000 and that's it, without taking the $24,000 brokerage withholding. But some brokerage would only show $153,000. So it goes to show like, hey, it's important to go into the detail and obtain this tax worksheet to understand what the background is. And then this one doesn't really show. Usually at the bottom of your net earnings, there are a bunch of fees being charged by the brokerage, like desk fees or like photocopy fees. Sometimes they even charge an advance. We've noticed some of the amounts being deducted and or some of the amounts being deposited, the commission auto deposit doesn't necessarily match with this. And there's always a reason. It's just that we need to be able to reconcile and know and then report the right amount. So brokerage fees are totally tax deductible. Just make sure that it reconciles to the tax worksheet. Referral fees. So we all know that referral fees, I'm on camera, so we all know that referral fees are not allowed by RICO. At one point in my life, I got my brokerage license, so I know referral fees for sure are not allowed. Now, but if you have referral fee, like you're paying, doing client rebate, so you're giving back some of the commissions that you back to the client. It is tax deductible and legally it's allowed, but the way that you pay it you want to get the tax deduction. You don't want to just pay cash because cash, unless you get some sort of an acknowledgement from your client, essentially, if CRA ever audit you, you pay like $5,000 back to your client, you're not seeing any documentation, then you're screwed. Because there are lots of realtor court cases in the past. Primarily, they are all in BC for some reasons, but then the cash return of commission would not be sufficient. You need to be able to get some sort of documentation. In a perfect world, you want to pay it through your brokerage if you're paying back to your client. I think in Alberta, I did a presentation to the Edmonton Board of Realtors in the past, and they told me that in Alberta, they mandated that the referral fee or rebate, client rebate, to be paid directly through the brokerage. So it doesn't even hit your T4A altogether. So it's not part of a commission. It's already being paid from the top line, which is way better than you doing all the documentation. Yes.
So my brokerage did that, and I used them, and they gave my client a T4. And
T4.
Yeah, and
T4.
Yeah, and then I did it on my own. Like, two of my clients got really angry. But then my broker said their accountant advised them to do that.
It's not a T4, T4A maybe. Yes.
Yeah, T4A, sorry.
Yeah, because they want to deduct it, right? Now, here's the thing. So the follow-up question is, hey, I'm giving back my client a $5,000 check. Do they have to report it as income? That's usually the follow-up question.
They should, right? I told my client you have to do
Something.
you have to report your income. If I pay you this.
$5,000. So the answer to that is a little bit complicated. If they are buying primary residence or selling their own primary residence, technically it's not taxable. It is related to the purchase and sale, and therefore it is not taxable. Now, if they're doing it, like they're buying a rental property, then that $5,000 is related to the purchase or the sale. So then the purchase cost of their property, instead of $500,000, it's now $495,000. So then when they eventually sell it for $1 million, they have to report that $505,000 capital gain instead of the $500,000. So it's not an immediate tax impact in those scenarios. Now, on the other hand, if they're buying something to flip, then again, it's being adjusted. And then when they flip it, the profit is being recognized that way. They have to report it, but it's reported, there's no immediate tax impact.
But for the primary
Residence,
he doesn't need to report.
No.
But for my side, what I'm gonna do?
You have to, you can deduct
I
it.
can deduct it.
Yeah, you can deduct it. Now, how you document it, the best way is write down the check.
Yeah.
If they issue a T4A, and once they issue a T4A, it's a problem because they have to report it, they do the matching.
What if it's been going through the brokerage? Let's say if you gone through to you first and then you write a check. Does that work?
Yeah, that works too.
But do you have to give T4A or no?
You don't have to, but on the check, you have to clearly document who you give it to. Yes.
Okay.
Yeah, and write it down that it's client rebate related to this particular deal. Yeah. So then that would be sufficient.
I heard other realtor that they give, let's say they give certain percentage to their client.
Yeah.
But then they hold off like the tax percentage, so it's not the full percentage.
Well, yeah, for sure, because I don't know if I'm understanding that position clearly, because you charge $20,000, but you don't actually just charge $20,000. It's $20,000 plus HST, so it's $22,600. So the client is expecting a cut from $22,600, but it's really you're really pocketing $20,000. Yeah, so then you should take that off. I'm not sure if we're talking about the same thing, because the tax impact could be the HST impact as well as the income tax impact.
I think it's probably more it's probably more the taxable income of the 20,000. So what would you as an agent, what would your tax bracket then for that 20,000?
So then,
and you're given 5,000.
Yeah.
Right, so you're going to be taxed on that 5,000 because it would have been part of the because you've received the 20,000.
Yeah.
So you're going to be taxed based on the 20,000 that you receive, but you're actually given 5,000. So you're only really net 15, but you're being taxed on 20.
But
so
then,
how do you calculate the tax for that 5,000?
Those are great questions.
I think that's what you're asking,
That's exactly
right?
what
If you pay through brokerage and your good with that.
Yeah, if you're paying
You
through,
get to the offer.
exactly. So as long as you don't pay tax on that amount, then that's great. Yeah. Using a check would allow you to deduct it, so you actually pay tax on only the 15. And if like you have a client who's really upset and really think that they don't have to pay tax, we live in Canada. Unfortunately, you're pocketing some money. Now, if that's the case and you really want to calculate, the most aggressive way is, hey, the marginal tax rate, it's like close to 50% majority of people. Here, I think I may have a slide later on to show you if you own your business in the personal name, it will be close to 50%. Anything over 150,000 net is over 48%. So it doesn't matter. So you can take 50% off if you're not planning to deduct it at all. But you're eligible to deduct it. CRA allows it. The Income Tax Act allows it. There are court cases that allow it. It's just that you do have to document it. An acknowledgement from the client is in relation to purchasing your primary residence. And I have clients, I have worked with during my early years when I was a realtor, my Deloitte partner had to purchase a place in London. And he was trying to call everyone up to see the property, tried not to use an agent, but nobody would respond to him. And so he asked me to schedule the meeting with him. So I got the commission and he asked me for a commission kickback. But I gave him the kickback and he said that, well, I'm comfortable not to report anything because it is related to my primary residence purchase. But if I ever need anything, he would be there to share that information with me.
Okay.
So.
That's very cool. So, okay. As long as it's for primary residence, they don't need to, they can report, but they don't need to really pay the tax.
They don't report it.
They don't need to even report. Okay,
Yeah,
that's
yeah.
cool. But I already told my client.
But you still get to claim it as an expense or a deduction.
You should be able to claim it as a deduction.
But for us,
For
for
you.
client, they don't need it to report.
The way that if they are selling their primary residence, then the gain would be a bit bigger. So the way of reporting it is not, hey, it's my income. It is through Schedule 3 on the reporting side.
Okay.
What about the HST portion?
HST?
Yeah.
So you would have charged HST on the full $20,000 and it is part of it. And when you pay your client, if you pay them $5,000, they don't charge you HST, then you pay that, yeah, it's a wash, right? So gift card. We mentioned earlier, grocery, restaurant, LCBO, all these are only 50% deductible. Make sure you document the name of the person receiving the gift card and why you're giving the gifts. Remember, we always have to document the cause and effect relationship, cause of why we're giving, and then how it is tied to earning the income.
Question. It's very, it sounds like it's very vague. Like, why are you giving the gift, right?
Yeah.
Like, for me, like, I constantly give gifts. It doesn't have to be a reason. It's just like relationship maintenance. Like, is that?
Then you will just write it down.
It's 50%, right?
No.
Just document it.
Oh, document.
Yeah, documenting. Not all of them are 50% like you mentioned before, right? Home Depot and all these, but I'm just calling these out that those are only 50% deductible. If you want 100% tax deductible gift card, then buy Amazon, buy a non-food related stuff, alcohol related.
Just to buy a gift, for example, even no matter $2,000, $5,000 gift.
You would be able to deduct it.
Oh,
The Yorkdale gift cards is 100% too.
Yeah. Fairview, right? Yorkdale is
So
Fairview.
let's say like I have renters start off renting.
Yeah.
I have hope in them in the next 10 years that they will purchase in some time. So I continue to invest in this relationship for 10 years. So let's say I'm sitting in a negative.
every year. You
Yeah.
have to
So like,
pay.
is that justifiable? Like, cause I'm hoping for a future purchase, right?
It wasn't just as long as you have a strategy
Yeah.
and it's reasonable. Like you're not going to give these people a $500 gift card every single year, right? You're going to give something small to stay in front of them, stay on top of their mind. When they decide to buy, they will reach out to you. That's what you are hoping for. You're not going to invest $500, $1,000 every year. You're going to invest $50.
You're not sending them on vacations.
Yeah.
When they do a deal with me, maybe.
Yeah.
But like right now, it's just like small dollars. But,
Yeah.
but when you have to say, when I have to prove the cost and revenue effects, it's not there yet.
Yeah.
Yeah.
I understand, but there is a reason, and it's not as strong. It is there. It's just not as strong. Not like, hey, I am giving my client a $5,000 rebate because they made me $20,000. It's not as strong, but it is there. And if you are doing it as a strategy for your marketing, yes, then you're not singling out one person because she's your sister-in-law or something. You're doing it because you're doing it to everybody. Then there is a strategy involved.
Okay, got
Yeah.
it.
And then if better yet, someone is actually going through you to buy a property, and if it prove that your strategy is working, then it will be a way stronger case too.
Okay.
Yeah.
Okay, makes sense.
Would the CRA actually contact these people then?
Great question. Not through my experience. They did ask for a list, the name as well as the contact information. Not that I'm aware of that they would they have a choice to do it. Would they do it? I don't know. Did they do it? I don't
I've
know.
heard of an instance where they actually did,
Yeah.
but that's because his whole case was very questionable for 5 years.
Yeah.
Right? But
Yeah.
basically, if they ask you for these receipts and you show the names behind it, they probably won't contact.
Exactly.
Because it's like, oh, you're prepared. You already documented all
Exactly.
this. There's no reason to doubt.
Yeah. So I've also heard of a case that majority of the gift cards got declined because there are some smart realtors out there that would buy gift cards for Moors because they need to buy suits so for themselves, but they're saying that it's gift cards. If you do something like that sketchy, because you're not going to buy a Moors gift card for a client purchasing at home, that just don't relate to each other, then those could easily get declined if they see a benefit to it.
Or like a gas card.
Gas card is not as bad. Gas card make more sense, but Moors or I don't know, Canada Goose gift card. I don't even know if they have Canada Goose gift card.
But you can just buy Canada Goose to give to your client. It's okay, right? For example, I'm just
Yeah, but then you do have to document it, and if the CRA agent, because they are just random people too, right? So if they choose to call that person,
to ask, did you get Canada Goose?
yes, then they have to say that yes, they did. And so those are the questions.
Sorry, before you go, I missed it. I was wondering, Visa gift card and Master gift card, does that work?
Yeah.
That works, right?
Yeah.
100%?
Yes.
Okay, perfect.
You have to document the name again. Document the name
of course.
receiving it.
Just some bank.
No. You can buy a gas station where you can get a Visa and Master gift cards.
Yeah. But there's service charge.
Yes. It's
Yes.
I think about 5%.
3 or $5?
Yeah. So, about 3%, somewhere around there.
Yeah. So
You can buy those.
medical expense. This is an interesting one because I did a lot of learning on this, and some literature really says that you cannot do it. Some literature says that you can do it. The way it works is that if you are an incorporated business, so if you already have a PREC to begin with, you can set up something called a health spending account with the corporation, with a service provider. Essentially, let's say you have a medical bill of $10,000. I'm picking $10,000 is easier to understand. They would charge you 5%, which is $500. 5% on 10,000 is $500. So they will charge you $500, $10,000 and $500. You transfer the money to that service provider, and they pocket the 5%, and they'll send that $10,000 back to the person, so your personal name. And in the corporation, instead of you may have a gross revenue of $200,000. Now, because of this $10,500 medical expense, now you only have a revenue of $200 minus the $10,500, and so you don't pay tax on that medical expenses at all. Now, CRA has come out and said that while some of these practices are self-insured and they don't qualify as a private health services plan, some of the providers seems to be okay with it. If you have an assistant and you're also providing that same service to them, then it's more likely that you would be able to also use it for yourself. But if you're only providing this service to yourself, it is a little bit harder to get this service. However, if you are engaging an external company, benefit company to provide medical services to your entire family, then it is a legitimate business expense in there. It's just that with this health spending account, you incur the expense, you send it to the service provider, they charge you an additional 5%. It's not quite, there's no element of insurance. So something to think about. I don't remember why I added that. Okay. Oh, I now understand now. So those are the questions, those are the most common expenses that you would incur. Are there any particular questions that you have with the medical, with all the expenses that you are eligible to deduct? I think those are the most common questions. I do have the top 10 or deductions in the book as well, so you're welcome to look at it. Going with the same general deductibility rule, these are also all very common expenses that you would be eligible to deduct. Coaching and educational expenses would be tax deductible, accounting fees, board membership, selling costs, advertising, insurance. Any other specific one that's not listed here that you have questions about?
Minor renovation, what does that mean?
Oh, you might help your client to paint the house, do touch up.
Okay.
That would be part, if you absorb that cost and depend. Okay, home office, great. So home office expense, it gets more complicated depending on your particular situation. I love my job because everything is depends. There's no real answer to it. I just did a video on home office expense, and it was released yesterday. And the criteria to deduct home office expense when you operate a business is that if you have to primarily use it as your base, principally used. To pull out the criteria because it's easier to present. Never mind, it will be here.
You connect to the Wi-Fi if you can do it.
Oh, I thought I connected. Sorry, that's my blog post. So to deduct home office expense, it has to be principal place of business. So that means there's only one place of business. The example, what's considered principal place of business, your home must be the chief or main place of business. So CLA gave some example. If you're a contractor, you work at multiple locations, and your home is the only place that you operate and do your bookkeeping and everything, then you can deduct that home office expense. The other criteria, you could use the other definition to deduct your expense. If you use exclusively to earn business income and use it on a regular and continuous basis to meet your clients and patients, that usually don't apply to realtors. Realtors pretty much is the principal place of business. Now, if you have an office here, say you have a dedicated office here, and you are spending majority of your time here to run your business, then you are not eligible to claim home office expense, just because based on that definition, you would not be. But on the other hand, some of my clients would only pay a desk fee. Like my husband only pay a desk fee, never show up at the brokerage to work one day. So then home office expense for him would be tax deductible. I don't know if that makes sense. In terms of the amount of home office expense you would be claiming, sorry, there's lots of stuff. You can claim the rent, mortgage, interest, utilities, minor repairs to the entire house that need to maintain the home office, as well as like the usual stuff, property taxes and insurance.
Oh, how many percentage?
It's based on the actual square footage or number of rooms. So if you have 100, it is just like that. So if you have a dedicated office space, let's say it's 100 square feet, and your whole house is 1,000, then 10% of all these expenses would be tax deductible. And you also have to keep your floor plan, because if you ever get audited by CLA, they ask for your floor plan.
Also, you only can deduct the office, you're using the portion for the
Yes.
house. Still good.
Well, it's usually a few $1,000s, a couple $1,000s to a few $1,000s. Now the questions then come, hey, what if I renovate my office, my home office, only my home office? If you renovate, it's minor, then you can write it off 100% of that. But if you're saying like, hey, I upgraded my roof and furnace of the whole house, then those are capitalized items. Then you cannot write anything off at all. So that makes a difference. And then some people would ask me, hey, Cherry, I live in a condo and I work from my kitchen island. How am I supposed to deduct? Well, CRA says that if you only use it for a portion during the day, you can only deduct that time. So you have to, I know, so that gets really complicated.
But if you're using it, but you use it to meet clients, what are you gonna do?
Yeah, so like it would be bad. I hope that person would have an office space. So there is a limitation. If you're not making money net before deducting home office expense, you're net negative. You're not allowed to deduct the home office expense. It will be carried forward to future years to deduct when you make positive. And will it affect my primary residence exemption on sale of the property? Typically, it's not. It won't unless you have an income producing use and you did some structural change to your property to accommodate that use. So typically, it won't. But it goes back to how you use your primary residence. Let's say you have a bungalow, raised bungalow, you rent out your basement already. The house has to claim primary residence, the full house has to be primarily used as your residence. So if you already rent out 50% of your property, it's not primarily used as your primary residence. So you likely would have a capital gain implication on 50% of the property. And the other 50% you would be able to claim primary residence exemption. So that's it on that. Sorry, I have this, right? Do I still have it? Okay. Okay, any other deduction? Any questions on deductions? Okay. And then corporation setup, if you haven't done so already. Many people ask me if they should set up a corporation and what is the magic code number to set up a corporation. It's actually a function of your personal spending versus how much you make. So everyone's situation is different. Now, so there is something called tax integration in Canada. What it means is that the Tax Act is designed in a way that if you earn the income in your personal name, the amount of your taxes that you would pay is the same as if you were to earn it in the corporation and then take everything out from the corporation. Does that make sense? It's supposed to be the same. Supposed.
Oh, so no matter I have the corporation or my own, but the tax, the amount deductible is exactly the same.
So let's say you earn net $100,000. The $100,000 in your personal name, the personal tax that you pay would be more or less equal the same within a couple percentage points because it's not perfect. If you earn that $100,000 in the corporation, pay the corporation tax, and then take all the money out from the corporation and pay personal tax on it, the tax between the corporation and the personal side would equals more or less the same as if you were to earn it in your personal name directly. But that assumption is based on the fact that you take every single dime out from your corporation.
Oh, so if I keep there...
If you keep it, you only pay 12.2% in the corporation, and this is your personal tax rate.
Oh, so
20%.
Corporation is better.
Corporation is only 12.2.
It's much better.
Yes, so there is a tax deferral, essentially.
But if I take money out...
All of it out, then there is no point setting up the corporation. But why would you need to take everything out? Now, there are a few reasons. You don't do really well this year in your business, so you actually do need to take every single dime out. And other reason is that, hey, I spend a lot. then you really do. You do really well, you net $200,000-300,000, but they also need $200,000-300,000 out because of their personal lifestyle. So everyone's situation is a little bit different, so that's why there is no magical number. Some people make $50,000 realtor commission income, but because they already have a full-time job, that setting up corporation totally makes sense for them because they only pay.
As long as above 50,000, I think it makes sense to make a corporation, right? Or
No, not because of the 50,000. It's because they don't need the money from the corporation. Remember, if you take it all out, it's the same tax. But if you don't need the money, you set up a
but one
corporation.
day in the future, I still need the money.
Yes. Then at the time, then you may not make as much money and you spread it out. So our personal income tax system in Canada is a progressive tax system. So under $46,000, you pay 20% tax. And then between 46 and 50,000, that delta of $4,000, you pay 24% tax. And it all goes all the way up. Now this is net income. So if you gross 500,000 and you have lots and lots of expenses, you can deduct them. And it's only the net income that count. Okay?
Net income.
Not gross, have nothing to do with your gross, okay? Some people have $1 million commission, but their expenses could be 700,000, so they net 300. Some people's gross commission could be 500,000, but their expense is only 100, then they net 400. 400 is what is being subject to the tax. Now, the beauty or the sad part is that this tax rate go all the way up to 53.5% in Ontario. The good news is that every single one of us have the same set of low tax rate every single year. So what I mean is that if I have a husband who's not making as much money, he could potentially get money from my business somehow, have a documented job, legitimate job, and get money and pay low tax rate of 20%.
You give the salary to your husband.
Yeah, with a real job, a documented job, yes.
I understand.
Yeah. Now, or if you have a lower income parents, they don't have anything else, you give them $46,000, they're only paying 20%. If you were to keep it, you may pay over 53%. So every single one, every single year has the same set of low tax rate. So that's the beauty, although also shitty part of the system. So which means that if you want any type of tax planning, majority of the time is all the tax planning strategy out there is about spreading it out to multiple people and spreading it out to multiple years, spreading your income out to multiple years. So that's all the planning strategies out there. Spreading it out to as many people as possible and spreading it out to over as many years as possible. So for someone that's netting $150,000, you have to pay $45,000 of tax. You go through every single tax bracket to calculate and add them all up, and that's how you calculate the tax.
Give me a second. I didn't get the point.
So if you were to earn net $150,000 commission, then you go through every single tax bracket and multiply that tax bracket delta with the corresponding marginal tax rate. Between $0 and $11 is an Ontario personal tax exemption, so there is no tax. Between $11,000 and $14,000, that is the first tax bracket of Ontario. So then you pay 5%. But between $14,000 and $46,000, that's the first starting federal tax rate and Ontario. So combined is 20%. So you multiply 20% times the $32,000 delta and you pay $6,400 of $3,082. You add them all up if you're 150. That's how our personal tax system works. Our corporation is a separate legal entity. It files its tax return on its own. It's also being subject to 12.2% on the first $500,000 that you receive, net.
First 500,000.
Net. So net of expenses, you can be $1 million and have $200,000 expense. You net 800,000. The first 500 would be taxed at 12.2%. The next 300 will be taxed at 26%.
Okay.
Yep.
So corporation is better.
Yes, for sure. But then, but remember, I mentioned earlier, if you take all the money out, you need the entire 800. There
But
is
I don't
no.
need for example, I don't need to
Yes.
take them out.
Yes.
Immediately, I can take maybe this year a little bit,
then next year.
next year a little bit.
Yeah, exactly.
And
then you will permanently save the tax by using the corporation vehicle. And that's what everybody does, and that's what all the doctors and dentists did in the past. All the doctors and dentists had their kids as a shareholder, and the kids are drawing out $40,000-$50,000 tax free from their medical corporation in the past. And then Justin Trudeau and Bill Morneau came along and then changed all of that, and they do not allow any of that.
really?
Yes. So, but in the last 10, 15 years, instead of giving them the raise, they give them the tax break, which is equivalent to a raise. But then now they took it away in 2017. Now, so let's use an example to explain. I explained this earlier. Let's look at a real estate agent named Peter. He earns $220,000 gross commission income and about $70,000 expense. And so he reports $150,000 net business income. Peter's paid $45,000 of income tax. About now is close to $7,000 of CPP. At the time when I did the presentation, it was $5,500 only. When you report everything in your personal name, you have to pay CPP as well, both employer and employee portion of CPP. If you work for someone, your employer pays the employer portion of CPP, and you pay the employee portion. But if you work for yourself, you have to pay both. You contribute both. Now, his after-tax earning is about just under $100,000. Now, we look at the personal need of a realtor to determine if the realtor should set up a corporation. In this case, personal need of realtor is only $60,000 annually. So you can see if he earns